put that in perspective, let's say a young colleague of yours is now in the labor force and they're working full time and they're well employed. They're getting paid, let's call it $100,000 a year, something like that.
Mhm.
If the US dollar loses 75% of its purchasing power, which I believe it will, that same young person will need to spend $400,000 10 years from now to acquire the same basket of goods and services that she purchases for $100,000 today.
Mhm.
That means that you need to think about the return that you can expect on your savings. You need to think about what your retirement is going to look like because you can't think in constant dollar terms. You have to think in deteriorating dollar terms.
Hey y'all, this is Tiffany Georgopoulos here, and today I'm here with Rick Rule. Rick, the last time I saw you, we were at your conference. How have you been?
Uh, I've been well. Thank you for your participation in the conference. It was a delight to meet you, and it was a delight to see your whole team down there.
Oh, thank you so much. It was a delight to meet you too, and I'm so happy to be talking to you again. So, as you know, I'm still very new to the natural resource sector. I've been working with natural resource stocks since January, and I've learned a lot of things that I wouldn't otherwise know. And over the past few months, I kept seeing de-dollarization come up on my explore page, my social medias, and the question that seems to be asked is whether or not the dollar will lose its dominance. But I thought a better question to ask would be fiat currencies compared to hard assets. So before we dive into it, Rick, could you briefly explain a little bit of what fiat currency is, how it gets its value, and how that compares to things like gold and other tangible assets?
A big assignment, but I'll do my best. A fiat currency is a currency whose value as a medium of exchange is established not because it's collateralized, but rather because of trust in the institution that issues it.
Mhm.
The US dollar exists as a medium of exchange rather than a store of value because it is believed to be, in effect, a current instrument of the US government. And the US government, at least relative to other governments on a global basis, for a couple hundred years, has proven to be more trustworthy. Now, more trustworthy compared to other governments, uh, may be how could you say false praise, but traditionally, and I'm talking way, way, way back, there were all kinds of mediums of exchange. Mostly those mediums of exchange were simultaneously stores of value. The
Mhm.
dollar isn't something that can be eaten. It isn't something that you can pound a nail into that holds up a building. In other words, it's a promise to pay rather than payment itself. Its value is a consequence of the fact that people believe that having acquired dollars, they can exchange them for something that they want or need. The difference between a real asset and a fiat asset is that a real asset isn't a promise to pay. It isn't faith based. It is, in fact, payment. When you receive 47 or $4,800 today, you receive it with the sense that you can take it to the store tomorrow or a year from now and get something or some things with it that you can use. In other words, it is a promise secured by faith in the future acceptance of that promise. If rather than $4,800 you got gold, it isn't a promise to pay, it's payment. Now, the value of that gold, at least the nominal value of that gold in our society, is ironically measured in dollars. So it's important to note that from a practical point of view, for you and I, there is an interchangeability between real assets and fiat currencies.
Mhm. Okay, well, that was very well said. I love the explanation. And then going back to what I briefly mentioned in the intro, there's a lot of talk about the de-dollarization. And if countries want to reduce their dependence on the dollar, if they could, how do you think they would even start to go about doing that?
I think they have been doing it. Foreign holdings of U.S. Treasury securities as a percentage of the total assets that foreign governments hold has been declining, and it's been declining fairly steadily.
Mhm.
And I suspect that's been happening for two reasons. The first is that the US government has decided to weaponize the dollar, to use the dollar as an instrument of foreign policy. Whether or not you or your listeners agree with the Russian actions against the Ukraine, as an example, there is no denying that the United States government stole $300 billion in Russian assets in the form of US Treasury securities. Had that $300 billion credit been in the form of gold in Moscow, the U.S. government would have no recourse against it. But they simply, in effect, canceled the treasuries and stole $300 billion in Russian government assets. That caused other foreign governments who think that they might run afoul of the U.S. government, and by the way, those include Canada now, to consider whether or not the U.S. was a reliable counterparty.
Mhm.
Separately and apart from that, and we can discuss this more in de-dollarization, there is a sense around the world, in the United States, but in other places too, that the purchasing power of the US dollar is eroding at a much greater rate than it was at the past.
Mhm.
This is where a young audience like yours needs to really focus. In the United States, most people think that the rate of deterioration in their purchasing power, occasionally referred to as inflation, is measured by the Consumer Price Index, the CPI.
Mhm.
Many people around the world, myself included, believe that the real rate of deterioration of the US dollar is substantially greater than the rate suggested by the CPI. The CPI would have you believe, Tiffany, that your savings are being degraded at the rate of 3% compounded. I would ask you and your listeners to look at the basket of goods and services that you purchase, that
Mhm.
your household purchases today and in 2020, and decide whether the rate of deterioration is only 3% or if it's some number that's higher. Your
Mhm.
gasoline prices have doubled.
Of
Your
course.
property tax, depending on your jurisdiction, has doubled. The price of your groceries has doubled. Your 30-year mortgage, assuming that people your age are able to get 30-year mortgages, has doubled. And yet the
Mhm.
government tells you that the rate of deterioration of the US dollar is between 2.5% and 3% compounded.
Mhm.
Uh, that is really what de-dollarization is all about. It's the belief on the part of various counterparties, both domestic and foreign, that the deterioration in the purchasing power of the US dollar means that the very high status enjoyed by US Treasury securities in the past is eroding rapidly.
Mhm. So going off of that, with it depreciating and the inflation of the US dollar just going up and everything's more expensive, we see governments that are printing more money, but at the same time, central banks are getting more gold, which is pretty contradicting. Why do you think that is, and what do you think that means?
I don't think it's contradictory at all. Uh,
Interesting.
Tiffany, if quantitative easing
Mhm.
was such a good thing, they should let you do it. You should be able to print Tiffany's. And if you could talk to
Mhm.
somebody into buying Tiffany's, you should be allowed to do that. If you do it, it's called counterfeiting. If they do
Ah,
it, if they do it, it's called quantitative easing.
hmm. I
It's the
never
same
thought of
thing.
it that way.
Printing additional currency units with nothing to back them is in effect counterfeiting. They don't call
Mhm.
it counterfeiting because they do it. But as I say, if it was great policy, they should let you do it. If you do
I
it,
agree.
you go to prison. If they do it, they get reelected. Um, but the process is the same. Let's assume that the stock of currency in the nation of Tiffany right now is a million Tiffany's. And Tiffany's economy, her utility to the world, means roughly that Tiffany is worth a million Tiffany's. Let's say that the value of Tiffany's goods and services don't go up, but Tiffany, because she wants to buy some merchandise at the name at her namesake store, Tiffany's,
Mhm.
decide that she's going to print 150,000 Tiffany's
Uh-huh.
unbacked by increased utilities. That would be called de-Tiffanization. In other words, the new Tiffany's that you printed up would be specious and counterfeited.
Mhm.
But once again, if Tiffany does it, it's a felony. If the Treasury does it, it's quantitative easing.
Interesting. I love the analogy of the Tiffany's. I'm definitely going to use that.
I
But
mean, frankly, I'd probably prefer Tiffany's. But
But so if printing money or more Tiffany's doesn't automatically make the asset prices go up, then what actually causes asset inflation, or better yet, what do you think has to happen for all of this new money to actually push asset prices higher?
I would argue that it does make prices go up. Uh, and this is instructive for your young audience as well. Beginning in about 2000, well, not about, beginning in 2000, I began to denominate most of my savings in gold.
Mhm.
That isn't to say I don't save US dollars too. I do. I maintain liquidity in US dollars, but I save in gold. And this 26 years has been very instructive for me. First of all, because I save in gold, my savings are larger than they otherwise would have been measured in dollars. But what's
Mhm.
more useful is when I look at the price levels of things that I might want to buy and I price them in gold, things are cheap. Houses are cheap. Cars are cheap. Groceries are cheap. Gasoline is cheap measured in gold. Measured in dollars, all those things are expensive. The real prices of these houses, or cars, or whatever you want to do, reflect the deterioration in the purchasing power of the US dollar, not aggregate pricing levels measured in a constant like gold. So I would argue with you, Tiffany, that two things: artificially low interest rates and uh, counterfeiting. The printing of additional federal Tiffany's is responsible for the higher aggregate price levels. There are other things responsible too. It is true, particularly in the American economy, that we've enjoyed real benefits from technology. We are able to do more. We're able to create more utility with less inputs as a consequence of technology. The levels
Mhm.
of education that some of our young people, hopefully including you, have attained means that your utility to society, your ability to generate wealth, is greater than it used to be. And that means that you can afford more stuff. By the way, this doesn't apply to all young people or all old people. But there are truths about aggregate pricing levels that don't just have to do with the deterioration in the purchasing power of the US dollar. But I would argue that most of the price escalation that we have seen has really been the consequence, the arithmetic consequence of the decline in purchasing power of the dollar.
Mhm.
It's instructive to note, uh, and by the way, this isn't some cranky 73-year-old libertarian named Rick Rule talking to you. It's important to note that since the institution of the Federal Reserve in 1913, that the US dollar, measured by the US government, the aggregate purchasing power of the US dollar, has declined by 97%.
That's insane. I didn't know that. So that's a very large amount to have a depreciation in. Wow.
And if you want to make it a little more current, but not too much more current, in the decade of the 70s, 1970 to 1980, the last time of really truly ugly measurable inflation, according to the then Congressional Budget Office, the US dollar lost 75% of its purchasing power. So you don't have to go all the way back to 1913
Mm.
to look at really dramatic erosion of the purchasing power. To put that in perspective, let's say a young colleague of yours is now in the labor force and they're working full time and they're well employed. They're getting paid, let's call it $100,000 a year, something like that.
Mhm.
If the US dollar loses 75% of its purchasing power, which I believe it will, That same young person will need to spend $400,000 10 years from now to acquire the same basket of goods and services that she purchases for $100,000 today.
Mhm.
That means that you need to think about the return that you can expect on your savings. You need to think about what your retirement is going to look like because you can't think in constant dollar terms. You have to think in deteriorating dollar terms.
So I think it seems, or at least to me, from that understanding, is investing in things like gold or tangible assets are a way as almost wealth protection to grow your wealth, but also keep away from the dollar depreciation. And then going off of that, you mentioned that you've been in gold for 26 years, or you've been keeping your money in gold for 26 years. So gold has outperformed the S&P 500 over the last 25 years. So what do you think that that tells us about monetary inflation, monetary policy, all of that?
I'm going to duck that question, Tiffany. I'll tell you why. I know a lot about natural resource-based businesses,
Hmm.
and I know a lot about valuing them, and I know a lot about conventional financial services businesses, banks, insurance companies, wealth managers, asset managers. I don't know much about many other sectors. So I can't tell you myself whether the S&P 500 is overvalued or undervalued. I can't tell you what Nvidia is worth. I can't spell it or pronounce it. Uh, I can only comment on the performance of gold relative to its denominator, which is to
What?
say the US dollar.
Hmm.
The US dollar is priced in gold. And if you look at the relative levels of each, which is required to buy a house, a shopping cart full of groceries, or a tank full of gas, you will understand that gold in the last 26 years has fulfilled the same role for American savers uh, that it has for other savers over 1,000 years. You can't counterfeit gold. You can't conjure it up out of thin air. Well, Tiffany could print Tiffany's.
Hmm.
Tiffany, unless she's a better alchemist than I think she is, uh, can't combine a bunch of household ingredients in a vial and come out with gold.
Hmm.
She can't counterfeit gold, which means that gold has much less counterparty risk than mediums of exchange like dollars that can be and are being counterfeited.
So, could you go a little bit deeper and elaborate a little bit more on you saying the US dollar is priced in gold? Because I'm curious about that.
Other way around, gold is priced
Gold
in
is
US
priced in US
dollars.
dollars. Oh,
Yeah.
okay.
Yeah. I mean, if you right now, likely, if you were to call up our mutual friend Andy Scheckman and tell him that you wanted to buy an ounce of gold, he would quote you whatever the quote was, $4,800, and you would pay him in dollars and you
Hmm.
would receive your gold. If later on you wanted to use that gold, which had been your savings, to purchase something, you would call up Andy and say, I need to do something else with the money. And you would sell him back the gold and he would pay you in dollars again.
Hmm.
So gold, from the point of view of you and I who live in the United States, is priced in dollars. What I've learned in my own savings account is that gold, not month by month perhaps, but certainly year by year and absolutely decade by decade, wins me an increasingly large number of dollars, even relative to the deterioration in the purchasing power of the dollar.
Hmm.
In other words, gold maintains at least its real purchasing power. And when, I shouldn't say when, if people become inordinately concerned about the maintenance of purchasing power in the dollar or inordinately attracted to the price action in gold, what happens is that the delta between the value of gold and the value of the dollar increases.
Hmm.
I think it's important to know that.
Hmm.
We saw earlier this year, well, December of last year, January of this year, where for the first time in a very long time, gold gained momentum in the markets. And you saw sort of a parabolic increase in the gold price, and particularly in the silver price. Uh, Gold and silver can become overheated. It's important that you know that. It's important that you understand that over time, the price of gold comes to reflect the expectation that people have that the gold price will go up.
Could you go a little bit deeper into that?
Sure. Um, let's go back to the decade of the 70s. Gold had been price controlled for a very long time, which meant that its price was set by the US government. When the US government was unable to continue to control the price of gold on a global basis, gold was selling for $42 in Paris and $35 in New York. The US government deregulated the price of gold. They took a cap off the price of gold because they couldn't maintain the artificial cap. At the same time that that was happening, the US government was paying the bill for two wars, the war in Vietnam, which we lost, of course, and the war on poverty, which we lost too. What we had was a bunch of debt. And we couldn't increase taxes because they were already too high. And we didn't have the political will to decrease spending, sort of like today. In 1970, the gold price was $35 an ounce. By 1975, early 1975, the price of gold denominated in US dollars had risen from $35 to $200 per ounce. Inflation, rather than being a topic that was taught to you in economics class, was real. The price of a hamburger at McDonald's, I realize this is before you were born, but the price of a hamburger at McDonald's went from 20 cents to $1 in that period of time. People began to feel inflation. It became a political issue. And for a very brief period of time, 9 months to be exact, in 1975, we had the political will in the United States to let interest rates rise in hopes of dampening inflation. And we did. In 9 months, we cratered inflation. But while we cratered inflation, we cratered the long bond market as interest rates rose. We cratered an already weak stock market. We obliterated new home sales, and we obliterated sales of consumer durables, refrigerators, stoves, cars, things like that. The US consumer and the US political class lost their nerve, and again manipulated interest rates and again engaged in quantitative easing. In other words, we sent a political signal to the world that US politics in the near term was more important than the sanctity of the US dollar. When we allowed interest rates to rise, in other words, when we let the market set the price of credit and the US dollar, the gold price fell by half in 1975. When we lost our nerve, the gold price went on a roar from a low of $100 an ounce to a high of $850 an ounce, an 8.5-fold increase in 5 or 6 short years. I would argue, Tiffany, and I can't give you the exact number, but at some point in time, what happened was that the momentum in gold and the strength of the gold narrative relative to the dollar meant that gold's appreciation was based less on arithmetic and more on sentiment. In other words, it went up because it had been going up. I think we saw the same thing happen to the silver market in January of this year. I'm not suggesting that was an all-time high, but the parabolic move we saw in silver from $45 to $115 or $120, I think had much more to do with momentum chasing and the empowerment of a narrative. I don't think that the value of silver in 6 weeks tripled. I think the price did. So it's important to understand that markets over time work.
So then how, just going off of that, out of curiosity, gold and silver, they both gained a lot of momentum specifically in this past year and 2025. But what differentiate the two compared to US dollars from your perspective?
I would argue that they're different but related asset classes. And I need to say this is personal. Your orientation may vary completely from mine. I regard gold as wealth. I regard it as liquidity. I save in gold. I regard silver as a speculation, mostly leveraged gold.
Mm.
I own gold out of fear. When I own silver, I own it out of greed. And I'm not suggesting that I'm devoid of greed. I'm not. I'm a
Mm.
veteran speculator. In my own account, uh, the silver speculation was all about the fact that 5 or 6 years ago, silver was hated. I mean, really, truly hated.
Why?
Because a whole bunch of people speculated on silver in the so-called silver squeeze, thinking that they were somehow going to drive JP Morgan Chase into bankruptcy or something like that. And it failed. And the silver price failed. The consequence of that, I mean, there's no hate as sincere as the hate of a jilted lover. And
True.
the silver bugs were thoroughly jilted lovers. The price of silver was down in the sort of $20 range. And if you looked at any social media comment around silver, either people who were bored of it, saying,
Hmm.
why would you own your grandfather's asset class? Or they hated it because they just got done getting their ass kicked in silver.
Hmm.
Uh, there is nothing I like as a speculator more than hate. When people have expressed their hate on social media, it means they've already expressed their hate in their portfolio. And it meant that all the sellers of silver were done. It had
Hmm.
moved to very, very, very strong hands. I believed that all that had to happen for the silver price to rise was the hate to dissipate. In other words, hate had to give way to boredom.
Hmm.
Silver didn't have to be loved, it just had to be less hated.
Hmm.
And I also knew personally from experience that when a precious metals bull market started, it happens as a consequence of momentum in the gold business. Fear overwhelms greed and overwhelms hate. And at some point in time, the momentum in the gold price is enough to validate the narrative in the mind of the generalist investor, not the old, you know, gold bug crowd like me, but more people like you.
Hmm.
Experience has taught me that when the hard money narrative becomes accessible to the generalist investor, that leadership transitions from gold to silver. And I think you saw that in November, December, and January. And I think that's an instructive lesson going forward. I'm not sure why that is, Tiffany. I don't know why silver expresses that much upside and downside volatility rather relative to gold. I just know that it does. 4 times in my career, I have witnessed gold markets where the generalist investor came into our space. And the hallmark of each of those circumstances was that price leadership changed from gold to silver.
Hmm. Interesting. And so I wanted to bring up something that you mentioned. You said you save in gold out of fear.
Yep.
And Andy and I were talking about this the other day, how historically, if an investor went to financial advisors, they would have allocated less than about 1% in gold. And now we're seeing some advisors recommend allocations of 15 to 20%. So, given your experience, how do you view that?
I think I'm glad you said in my experience because I don't believe that there's a one size fits all answer. Your needs, your means, your time preference, your risk tolerance all go into your own investment allocation decision.
Hmm.
Here's what I think your investment allocation, Tiffany's investment allocation decision, needs to be centered around. The debt, the government debt, and the government deficits that my generation has left your generation with are arithmetically unserviceable.
Mm. How
Uh,
so?
it, well, I'll give you the numbers just for fun. Sorry for this math lesson,
Oh,
but
no, give me the numbers. I'm curious.
I think it's instructive. And understand that these aren't my numbers. The first number comes from the Internal Revenue Service, or as I prefer to call it, the Infernal Revenue Service.
Mhm.
They estimate that the private net worth of American citizens, and it's their business to know this number, is somewhere between 175 and 180 trillion dollars.
Mhm.
That's what we're worth, all of us individually. And that's ultimately what services the US debt. That's where the US government comes from. Nothing's government funded, it's all extracted from us, right?
Mhm.
So the top line number the number that we subtract from. Let's be generous and call it 180 trillion. Uh, Now let's start subtracting from it. That's what we have. This is what we owe. Okay. And this is just at the federal level, not including state and local levels. Okay. The on balance sheet liabilities of the US government, which is to say what we owe the bondholders, is $40 trillion. That doesn't look so bad against 175 or 180. But what really gets ugly, Tiffany, is that the net present value of unfunded liabilities, Medicare, Medicaid, Social Security, federal pensions, military pensions, if you want to quantify it for your audience, old folks, me, the net present value of the promises that our society has made to entitlement beneficiaries, according to the Office of Management and Budget, now the Congressional Budget Office, exceeds $120 trillion. So let's add 40 trillion to 120 trillion. The number that we come up with is 160 trillion. Let's be generous and knock $5 trillion off that number for the Fed's balance sheet. By the way, the benefits of counterfeiting, that's where that came from. But let's do this anyway. So we're worth 180 and we owe generously 155. That's a pretty ugly number. That would suggest that there's a delta of between 25 and 30 trillion between what we have and what we owe. Not a good thing. Remember, this is before state and local debts. But the math gets much worse. You see, this, let's be generous and call it $30 trillion number for fun. And by the way, that is a generous number. Grows by $2.5 trillion a year as a consequence of the deficit. Every year we spend $7.5 trillion, and every year we take in $5 trillion. Mm-hmm. Don't try this at home, Tiffany.
I'll stay away from it.
Good, but it gets worse because the accretion in the underfunding of entitlements also increases by about $2.5 trillion a year. So this number that we have, the difference between what we have and what we owe, let's be very generous and call it 30 trillion. There are other people who say it's 15 trillion. That's our cushion. It gets smaller every year by $5 trillion. It's inevitable that the lines cross. There are ways out. You know, the Argentines found a way out. They were honest. They had a default. They said to the bondholders, yes, we promised to pay you. Too bad, so sad. No money, strong letter to follow. We could say, and I would encourage, in fact, your generation to say precisely this. Listen, you guys made yourself all these promises. You forgot to pay for them. You fund your retirement. But that's not the American way. Old people vote, unlike young people. So my suspicion is that we continue to eat away the difference between what we have, the 175 or 180 trillion, and what we owe, the 155 or 160 trillion, until we hit a crisis point. I was taught a little poem by my grandfather, which I'll pass on to you, an old man's wisdom. And perhaps you can pass it on to your congressmen or congresswoman. It goes like this. When your outgo exceeds your income, your upkeep becomes your downfall. If we continue to spend $5 trillion more than we save, we hit a wall. The only way that we avoid that wall is counterfeiting, printing Tiffany's. And adding additional Tiffany's to the stock of existing Tiffany's without increasing our goods and services, which is to say, without concomitant growth, devalues all of the existing Tiffany's.
But how long did we do that for?
Well, the decade of the 70s, I think, is instructive. We began to see persistent and rampant inflation in the United States and ugly government deficits, beginning really in about 1967. The public wasn't cognizant of the problem until 1972. When the price of a McDonald's hamburger went from 20 to 25 cents, that was tolerable. After 5 years, when it had gone from 20 cents to $1, that was no longer tolerable. So it can take 5 years or so for the reality of the math to affect our behavior.
Mhm.
But your generation is already experiencing the consequences of it, experiencing the consequences twice, actually. Once, because I think society has failed to teach your generation that they get paid to create surplus utility for others. You don't actually get paid for your time. If you show up and do nothing and still get paid, you haven't created anything. You've stolen something. And an awful lot of people, my age and your age, don't understand that in order for you to sell your services or the products created with your services, you have to generate more value for society than you cost society. And then there's a second equation, which your generation has been cheated on, and that is the necessity of private savings. You need to produce more than you consume. The delta between what you produce and what you consume is your savings. It is your capital. And there is no way in society that most of us are going to sustain our standard of living simply by working for ourselves. We have to make our money work for ourselves. Ipso facto, if we don't save, we can't do it.
Mhm. And they
Uh,
don't really teach that in school. They really
they
don't.
they do not teach it in school. That's why I taught you that little ditty. My wish is that at some point in time in a young person's life, preferably fairly early, they came to understand that if they consumed more than they produced, that eventually they'd have a problem.
Mhm.
We're also taught, and we were taught in my generation too, not just yours. We're taught to envy. We are taught to blame others for what is much more reasonably our own shortcomings and failings. Tiffany, owe it to yourself to secure your future. I've cheated you. I have voted myself all kinds of cool benefits and I forgot to pay for them. I'm leaving you the bill. The consequence of my largesse towards myself is that society is going to be unable to express the same largesse for you that they expressed for me. Is that unfair? Yes. Uh, is anybody other than yourself going to look after you as a consequence? No.
Mhm. Well, that's all very informative. I'm definitely taking all of that with me. But with all of that information, all of this happening, the government debt, the gold buying, countries looking for alternatives to the dollar, what does that mean for investors and natural resources and other hard assets?
Well, I would suggest that most people's portfolios, particularly young people's portfolios, are wonderfully underrepresented in gold and natural resources. It is estimated by J.P. Morgan Chase, a big bank, for those of your listeners who don't know, that precious metals and precious metals related investments comprise about 0.5% of the total savings and investment assets of Americans. The 4 decade mean is 2%. If the market share of precious metals reverted to mean, that would involve a fourfold increase in demand. I can't tell you what that would do to price. I would suggest to you, Tiffany, although I don't know, that if I'm correct and the US dollar, as a consequence of debt and deficits, loses 75% of its purchasing power over 10 years, that the nominal price of gold, which is to say the US dollar price of gold, maintains its purchasing power, which is to suggest that the US dollar quoted price of gold will mirror the decline in the purchasing power of the US dollar. A
Mhm.
twofold increase, a threefold increase, a fourfold increase in the nominal gold quote? I would suggest yes. I would suggest that if you save in gold for the next 10 years, that you will enjoy the same experience in terms of the increase in the purchasing power of your savings that I have experienced in the year 2000 to 2026. I'm not sure you'll make money in actual terms. I'm not sure you'll gain purchasing power, but what you will do is not lose purchasing power.
which
There
is
will
great.
be
That's what I
there will
hope
be
for.
perturbations, right? I mean, the gold price recently in US dollars fell from 5,500 to 4,000. Now it's back from 4,000 to 4,800.
Mhm.
And I think people overly exaggerate this. I think
How
that you need
so?
to pay attention. Well, how old are you, Tiffany, roughly?
Well, I'm about to turn 22.
Okay. So, uh, 6 months matters in your imagination, but I suspect you have at least 60 or 70 years left on Earth.
Hopefully.
And the more time you spend thinking about 6 months and the less time you spend thinking about 10 years, uh, the worse your life is going to be when you're 32. In other words, you need to worry less about the perturbations in the gold price
Hmm.
and more about the maintenance of your purchasing power.
Mm.
I'm not suggesting, by the way, that you go all in on gold. I'm not suggesting that for a moment, just like I'm not suggesting that you go all in on anything. I am suggesting that you save aggressively, that
Mm.
you earn more than you spend, and that you save the delta and invest it. Some of your savings, I would suggest, should be in a medium like gold that maintains its purchasing power.
Hmm.
How
So,
much is an individual item? How much is up to you?
mhm. Yeah, well, I will definitely be taking that advice and using it. And I just have loved this conversation so far as I'm still new to this space and I'm still learning. So I just feel really grateful to be able to speak to you and hear your expertise. And when I last saw you, I asked you what your advice was to a young investor. And your advice was to invest in myself and figure
Correct.
out how much risk I'm willing to take. And I know you're not telling me, invest in gold, invest all my money in gold. Um, but I am curious once I am, you know, investing in myself and I'm figuring out what I want to put my money into. What should a young investor or a new investor know when deciding which companies or commodities to invest in to protect their wealth?
Investing in yourself means increasing your ability to analyze investments in companies. I think to do that, you start with reading. Uh, if I were God, a long way from there, I would make all youngsters start with a book called Economics in One Lesson by Hazlitt. It tells you about the way the economy is, not the way CNBC wishes it were. It's important that you understand the way the economy works because the economy, uh, in a very broad sense, is what generates investment returns. Then and by the way, don't just buy the book, read the damn thing, right? It does you no good on your bedside. The next book and you don't have to buy this, you can get it from the library. The next book that you read is The Intelligent Investor by Ben Graham. He had a pretty good pupil named Warren Buffett. Most of your listeners will know who that is. Uh,
Didn't he say not to invest in gold?
he did. He did. Buffett
Didn't he
did.
call it like a relic or
A
something?
pet. He called it a pet rock. Uh,
Oh, that's a
and, and, fr-
little.
and frankly, if you're Buffett, if you're as smart as Buffett, you don't need to invest in gold. During the decade of the 70s, during rampant inflation, he bought companies that were good enough, that had enough purchasing power, that he made a 25% compound internal rate of return for 14 years. Mr. Buffett is smarter than I am. I am not able to duplicate his investment performance. So while he didn't need gold, most of us mortals do. I think it's important to understand that. The intelligent investor teaches you the investing process. It teaches you patience, the time value of money. It teaches you that markets work, that you need to be a contrarian, that you need to be an anti trend follower. And it teaches you how to ascertain value. Again, don't merely check the book out of the library, read the damn thing. If you read that book and you employ the lessons, you will, over the course of your life, get rich. Not merely be solvent, you will get rich. But remember, I said you have to employ the lessons. And the lessons are very, very counterintuitive.
Mhm.
If you were inspired reading The Intelligent Investor, which I was as a young man, It was not a chore for me to read it. It was a joy for me to read it. If you read it, and it's like a light bulb goes off, the next book that you need to read is a really hard book. It's called Securities Analysis, also by Ben Graham.
Hmm.
The former book is probably the best investment book written over time, ever, relative to the effort required to read it, because it's easy to read. Securities Analysis is a cure for insomnia. It's a tough, tough, tough book. But if you practice, uh, it the intelligent investor tells you what to do. Securities analysis tells you how to do it.
Hmm.
It is what it says. It teaches you how to analyze securities, balance sheets, income statements. If you read those three books and you employ the lessons in those three books, you will navigate your financial future well, literally well. If you don't, if your investment technique or your speculative technique is got a hunch, bet a bunch, which is to say, if you decide to feel as opposed to think, I think the next 10 years are going to be very difficult.
Well, I will definitely get both of those books. Read the first one first,
Yep.
and then I'll read the second one after. And I hope by the time I talk to you next, I have more of an understanding to then talk to you about it and ask you about it because I would love
I,
to do that.
I look forward to that. I've had the good fortune to mentor thousands of people your age in my life,
Mhm.
and the lessons are counterintuitive, and they aren't taught to you in school. They
Mhm.
aren't taught to you by the media, but they're real lessons nonetheless.
Mhm.
Uh,
Well, I'd
and
love to
having
put them into action, and
having
I'm
them
excited for
codified for having them codified for you so that you can put them into action is really the first step in securing your financial future.
Oh, well, I'm looking forward to it as I just recently started my portfolio. So I'm just still learning. I'm investing in myself, reading in these books. I am excited to invest more into myself. But those are all the questions that I have for you today. We're almost out of time. But again, so grateful to be able to talk to you, to be able to even have the opportunity to interview you and hear about your experience and your expertise specifically within the topic of this interview. So I really appreciate it, Rick.
Well, I look forward to charting your progress. Congratulations for getting started.
Oh, thanks so much. Well, thank you so much, and I'll see you next time.
Thank you.